If you go back and look at the past, if you look at a graph of the economy for the last 50 years, it kind of looks like this. It's got an upward trend and very modest divergence from the trend. Sometimes the trend is a 2% trend line. Sometimes it's up 3 and sometimes 1. In extremes, it's up 4 or down 1 or 2. Very modest volatility. If you look at company results, companies have leverage, financial and operating, and their profits go like this. If the economy is up 2%, profits go up 10. If the economy is up 20%, profits go up 30, and so forth. And so if the economy is down 2, then for a typical company, maybe profits will be down 15. So the graph of profits is much more volatile than the graph of the economy. And then if you look at a graph of the stock market, it looks like this. Why? What's the difference? And the difference is psychology. Good. So I think that if you want to exist in the investment world, and you want to, you can just buy and hold good things if you want to take that approach. But if you want to improve upon that, I think it's very important to understand the ebb and flow of psychology and act accordingly. I think the response to the financial crisis was terrific. I think the financial crisis had the potential to really produce a depression. And if you read Hank Paulson's book, you'll see he was terrified. And what I was telling people back in 08, it was a newscaster, may have been Walter Cronkite, who once said, if you're not confused, you don't understand what's going on. And I told people in 08, if you're not afraid, you don't understand what's going on. I mean, we were highly levered. The banks were in free fall, and it looked like there was a vicious circle going on. And I think that Paulson, Bernanke, and Geithner did great things aggressively, and they worked. So there's anybody who would second guess anything they did is an idiot. And we are in the clear vis-a-vis the global financial crisis. And clearly, especially in this country, the other countries did not take the actions that trio took as early or as aggressively, and the other countries are not doing as well as we are and have not recovered to the same extent. So the direct effects of the global financial crisis are over, and we're doing quite well. We are in the 10th year of an economic recovery, the 10th year of a bull market, et cetera. However, the actions that we took to get out of the global financial crisis were extreme, and like all those medicines they advertise on TV, they have side effects. And now we have to go off the medicine. And you described it, I think you described it as an experiment. And if you conduct an experiment for the first time, it's folly to say that you know how it's going to go. There was never a stimulative exercise to the extent of the QE and the rate cuts. It never had rates at 0 before. And so now that we're trying to reverse the influences and sell the bonds, the securities that were bought through the quantitative easing, and bring the interest rates back up in the direction of normal, you can't say how it's going to go. The world's central banks have $22 trillion on their balance sheet now, almost probably quadruple what they had in normal time. And they have to end that. How's it going to go? What's going to be the effect? Can't tell you. So, and most people, over the last year or two, I get a lot of questions. And usually you can tell what's going on in the world from the questions, because usually at a point in time, a lot of people ask the same question. And one of the questions I've been getting for the last couple of years is, what could go wrong? Everything's going swimmingly, but we know it's not going to go well forever. What could bring it to a close? And clearly, an unspecified miscalculation by the Fed is one of those things. We don't know enough to know what the error would be, but we know that when you're doing something unprecedented, there can be error.